Before we jump into the types of traders and the techniques they use, there are a couple of pieces of information we need to keep in mind as we learn about how trading actually works. And we'll start with the basics of what a trader does. Stock trading is the active act of buying and selling stocks and managing positions. Now, a position is what a trade is called while the trader's money is in the market. It is very important that we understand the process of stock trading if we plan on risking our hard-earned money in the markets. So the following sections will outline the most common types of traders and the techniques they use to make money in the markets. The next piece of information we need to know before we jump into the different techniques is how volatility relates to trading. And stock trading works because of volatility. You see, all trading techniques exploit the price movements of a stock in one way or another. So without volatility, that is to say, fluctuations in a stock's price, traders wouldn't have anything to trade. So think of volatility as the lifeblood of a trader. In the same fashion, cash flow is the lifeblood of a business. So the more volatility that exists in the market, the greater the income opportunities of a trader. Now, without getting too bogged down with the methodologies behind trading psychology, as a trader, we don't trade the markets. We trade our beliefs about the market. And this means that each trade you and I make is a result of our perception of reality, not reality itself. And this may seem a little abstract, and that's okay. So let's look at an example to illustrate this point. Let's look at the classic question, is a glass half full or half empty? You can say it's half full, and I'd say it's half empty. And we could both be right. And the trades we put on, as a result of our perceptions, would be very different based upon our differing beliefs about how full the glass is. Next, we need to understand what a trend is. And a market trend is a directional movement of prices. So, like we talked about in the last module, bull and bear markets, if we're looking at them in terms of trends, a bull market would mean the stock market is in an uptrend because prices are rising. In contrast, a bear market would represent a downtrend, and trends can occur on the market level and individual stock level, as well as various time frames depending upon the type of trader. Finally, we have money management and position sizing. Before we jump into the different types of traders and the trading techniques, we need to talk about what money management is and more specifically what position sizing is, because it is the most important success factor when it comes to trading, regardless of the technique or strategy used. Position sizing answers the question of how much. How much money do we put on the line when we place a trade? While this may seem like a very simple subject, the mathematics and methodologies behind this are quite complex. Now, money management keeps us from risking too much money and blowing out our accounts. So if you decide you want to be a trader, make sure you learn about money management and position sizing, because as any professional trader will tell you, it's the most important part of your trading plan and system, even more important than chart reading and trading techniques.